Please note the information on Retire Vivid referenced in this video is accurate of February 21st, 2025. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm Cameron McCarty. That's Tommy Breitbach, and today's episode is your guide when it comes to the Roth IRA. There's rules that people need to be made aware of when it comes to this wonderful planning tool, because, I mean, Tommy, throughout all of our episodes, our viewers have seen it throughout since we've been airing, and we're a big fan of tax planning. How do we help people save money in taxes?
Yeah, we've talked about, the IRA or the 401k, how a lot of people's wealth is held there.
Right.
We've talked about the required minimum distributions down the road, how that can lead to a tax bomb, if you're not planning ahead. And so we've spent time talking about how to get money into a Roth from a tax planning perspective. But today we can talk about how, to use it or to access those funds.
Right. It's not as simple as, okay, I have a Roth, it's tax-free. That's not how it works. There's 2 5-year rules. Let's walk through those 2 5-year rules.
Yeah, there's an account level 5-year rule, meaning the account starts a birthday. In the calendar year, you make a contribution or the first conversion. So you have an account level 5-year rule. Then you also get into a conversion level 5-year rule. Typically applies to individuals under 59 and a half, but
right.
Each conversion under that age starts its own 5-year rule. So Plenty of things to be aware of.
It's not black and white. I mean, that's the point that we're trying to get at. And so that's why we're going to talk about this. So there's a lot to go through. So let's dive into this to help give our viewers some guidance when it comes to this, because again, we don't want people getting hurt out there. We want them making informed decisions when it comes to this wonderful planning tool. Okay, let's talk about the withdrawal order when it comes to a Roth. Let's start there.
If you've had a Roth IRA for a while, it can be made up of 3 parts. Money you've put in, potentially money you've converted, and then those dollars, what they've grown to, so your earnings portion.
What you're saying is big, because all of these are very important when it comes to withdrawals from a Roth IRA. So let's be more specific in terms of each one of those. So let's first start with contributions, because contributions always come out first. My question is it taxed? Is it penalized? Let's talk about that.
Contributions are money you have put in there. It's after-tax dollars going into a Roth.
You've already paid taxes on it.
You've already paid taxes on it, so that money is yours, accessible at any time.
Okay.
There's no holding period on those funds. They can be accessed without additional taxes or that 10% early withdrawal penalty.
Right. The other thing, too, when it comes to contributions is there's no age limits when it comes to that, because people hear about the 59 and a half rule, right? You get penalized. We'll give some examples here in a little bit. Okay, so when it comes to distributions, contributions come out first. Next would be converted dollars.
Yeah, so converted dollars is money you have moved from your traditional or pre-tax IRA into the after-tax or Roth IRA. You paid taxes on them when you converted. It was taxable to you when it was converted. That is an or. So converted dollars are if you satisfy the 5-year rule or 59 and a half when you are taking those converted funds.
That's a big one. I hope you caught on to that, the or part. Okay, now next would be investment earnings. So again, this is different. This is an and. Walk through that one.
So this is a 5-year rule and 59 and a half.
Got it.
So it's whichever is later of those 2, 5 years or 59 and a half.
Okay, so let's give some examples. So here we got an individual that's under age 59 and a half, and then we'll talk about an individual that's over age 59 and a half. So Tommy, let's walk through this. So here's an individual. They made a contribution. In this case, we're just saying $7,000. Okay, they're 40 years old. So and then that 7,000 turned into at age 43, it grew by $2,000. So that's $9,000 that it grew to. And then they decided they wanted to take a withdrawal. What happens next?
Yeah, so if they're looking at taking the full amount of that Roth IRA account, the contribution, it's their money. That money comes out tax and penalty free.
Because they've already paid tax.
It's after-tax money. It's theirs to use whenever they would like.
Right.
Typically not a recommendation, if these are retirement or long-term planning vehicles, you're looking at leaving it there. But if you need to access contributions tax and penalty free, the earnings portion of that would be taxed as ordinary income, and then under 59.5, you would have the 10% early withdrawal penalty as well.
Right, because we just said it. They did a contribution at age 40 and they pulled it all out at 43. We just talked about the first 5-year rule, the account level 5-year rule. It has not been satisfied.
The account level 5-year rule has not been satisfied.
Unless, go ahead.
And I was going to say, unless an exception applies, so this is normal type situations. If you apply or if you qualify for an exception, you may not have the tax liability or the penalty on those.
Right, and so for our viewers listening, you can see what those exceptions are on your screen. And so again, let's now talk about somebody that's over 59.5. Tommy, walk our viewers through this example.
So you are still looking at the account level 5-year rule, kind of regardless of your age. So
right.
In this example, the individual was 60, put in that same $7,000, had it for 3 years. The account's grown to a total of $9,000, and they want to access the full account balance.
Right.
Well, the money they have put in, your contributions, still come back to you, tax and penalty free. The $2,000 of earnings in that account would be assessed at income taxes because the account level 5-year rule has not been satisfied. They are over 59.5, so they do not have the 10% early withdrawal penalty.
But they did not satisfy the 5-year rule. So they're still subject, even though they are over 59.5, to pay ordinary income tax on the gains that they made on that Roth.
On the earnings, correct.
Okay, all right. And again, they did not satisfy the 5-year rule. So in another example, let's say to help get through this, we had an individual that made their very first contribution at age 50, okay? And then they made their first withdrawal at age 63. Well, here's the good news. They said there's 2 things that just happened here. Number one, they satisfied the account level 5-year rule, right? They've held it for 5 years and they're over 59.5. Tommy, do they pay any penalties or tax now?
The full balance of the Roth IRA in this example is available to them because they have the and in there, 5 years and 59.5.
Tommy, what do we want people to consider, right, when it comes to the Roth IRA?
Open that Roth IRA
Start
if you're eligible. Start that account at whenever your planning phase starts, but look at starting that Roth, outside of that 5-year window for when you may potentially use them.
Right. The moral of the story is, folks, get a Roth IRA. I mean, I'm not saying that everybody should do it, but if you're looking at tax planning, that could be the way to do it. Okay, we just talked about the contributions. We are now going to be moving on to Roth conversions with the 5-year converted rule. We're going to talk about later in the show people that have a Roth 401k as well too. What's this pro-rata rule, backdoor Roth? There's a lot more to go through more right after the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Okay, we are now moving on to Roth conversions. I mean, this is something we do a lot of with our clients. I mean, there's a lot of tax planning that comes into it. Tommy, explain what a Roth conversion is.
Yeah, a Roth conversion is when you take money from your pre-tax or traditional IRA, move it into a Roth IRA, and it is taxed in the year that the conversion happens. So you do pay ordinary income taxes on the amount that's converted. So from a tax planning perspective, you're reviewing tax buckets, where you are, where you may be, and seeing if a Roth conversion may make sense for you compared to where you may be going.
Got it. And so let's just say, for example, you did a Roth conversion in July. How does the IRS look at that? Do they look at your clock? And remember, we're talking about the 5-year rule. Does the clock start July, or what happens there?
So Roth conversions happen within a calendar year, January 1st to December 31st. And if these are the first funds going into your Roth IRA, so you opened your Roth IRA to convert, you did it in the middle of the year, the IRS will start your 5-year window back to January 1st of the calendar year the conversion happened.
Right. I mean, and again, the reason why they do this, and again, now there has been a lot of confusion on this 5-year clock on every conversion that you do. That can be true, but it depends, right? It depends.
It depends on your age, when you did it, how long you've had the account. A whole bunch of things have happened, but the reason they have that rule to prevent you from converting to a Roth IRA, taking that money out, you've already paid taxes on it, but taking it out without a penalty.
Right, to avoid penalties.
Yeah, you can avoid your penalty without this rule. So that's why they put a 5-year rule on conversions, especially under 59.5.
Thank you for the segue. Okay, so let's talk about doing Roth conversions that are under 59.5. So here's an example. We have an individual that converted money from their traditional IRA to the Roth of $50,000. Okay, they paid taxes when they did that. Okay, they created a taxable event. They did this at age 40. And let's just say, 2 years down the road, it's grown to 60. And so now they have $10,000 of gain from that Roth IRA. Tommy, walk what happens if they did a full distribution of that entire $60,000.
Yeah, if this individual wants to access that full $60,000 that they have in their Roth IRA, the converted amount that
the $50,000,
the money that has moved into the Roth, they paid taxes on it, but they are under 59.5, have not satisfied a 5-year rule. There will be a 10% early withdrawal penalty on the converted amount.
Okay.
Then looking at earnings, still under 59.5, so they will have that same early withdrawal penalty, 10% on the earnings, plus ordinary income tax rates on those earnings.
To summarize again, that $50,000 that they converted, they're not going to pay taxes on that because they already did pay taxes on that. But because they're under 59.5, they're still subject to that 10% penalty. And then to your point, on the $10,000 earnings, there's still going to be a 10% penalty, and they did not satisfy what? The 5-year rule.
5-year rule.
The 5-year rule. So they're still subject to taxes on the gains of this Roth, right?
Yeah, it's definitely something to be aware of if you're looking at doing conversions.
That's right.
And accessing those funds.
That's right. That's right. Okay, now let's use another example. So we just talked about an individual that was under 59.5. Now let's talk about somebody that's over 59.5. So same example. Okay, they took $50,000. So again, this individual took $50,000, converted that to a Roth. They pay taxes on that. So same example here, Tommy. So 58 years old, 50,000, and it grew to 60,000. So there's $10,000 of gain there. And then at age 60, they did a full withdrawal. What happens?
Yeah, so the difference in this example being the ages. So they went from under 59.5, 2 years later, we're over 59.5.
Right. Yeah.
So on your converted amount, you have already paid taxes on it, but you are over 59.5. So you are not paying the early withdrawal penalty on the converted amount.
Got it.
The 5-year rule for earnings has still not been satisfied for that account. So there's no 10% penalty on the earnings because they are over 59.5, but earnings can still be taxed as ordinary income.
Because they did not satisfy the 5-year rule, right? I mean, hopefully this is making sense for our viewers. I mean, I think they're starting to see that in terms of how this works, but let's muddy the water a little bit more. So let's just recap here again, just so our viewers can see, Tommy, for when it comes to withdrawing funds in terms of the Roth conversion.
Yeah, when earlier in segment A, we mentioned the withdrawal order. You have contributions, conversions, earnings.
Right.
This example, the converted amounts, the IRS will look at the earliest converted amounts, older first, and we mentioned the 5 years or 59.5. Mm-hmm. So under 59.5, conversions need to meet the 5-year rule to avoid the early withdrawal penalty.
Yep.
After 59 and a half. Penalties, the early withdrawal penalty doesn't apply to converted amounts, but we are still looking at the account level 5-year window.
Now, let's muddy the water a little bit more. I think this is where the confusion gets in, because everybody says, oh, well, yeah, it's a new clock on every conversion. Pump the brakes, it depends. Let's give an example there, and then we'll come back to the clock. Okay, so here we got an individual that's 58 years old, and what they're doing is every year they're doing a $20,000 Roth conversion. Okay, so once again, our viewers know this. When you do a conversion, you pay taxes to get from the traditional IRA to the Roth. And so as you can see, they're 58, 59, they're just doing those, they're doing those conversions. Okay, and so 58 is when they started that clock. And then 5 years later, they'll be 63 years old. So Tommy, if they wanted to do a full withdrawal or do any conversions after age 63, what happens?
So age 63, from 58, 59, 60, 61, 62, that's your 5-year window.
Yep.
Age 63, that amount becomes fully accessible to you because you have satisfied the account level 5-year rule. You're over 59 and a half. Your earnings, converted amounts, contributions still fully accessible to you, no taxes or early withdrawal penalties.
That's right. So this is the big one, folks. I mean, I see this all the time on different articles that people are reading, and they keep saying, yeah, there's a 5-year rule on every conversion you do. It depends. So in this case, the account level rule trumped the 5-year conversion rule. So you can see this here. So they satisfied these rules here. And so when they started doing Roth conversions after this point, they're good to go. There's no new clocks on future Roth conversions.
Right. And so, the takeaway from segment A was start a birthday on your Roth IRA.
Yeah.
So for, when we're looking at these, it's a lot of times it's the kind of retirement planning aspect of it.
Right.
So for individuals who are going to be over 59 and a half, start your 5-year window and then review conversions, contributions, those things down the road. But
Absolutely.
Get that Roth opened if you are thinking about going down the tax planning route.
I mean, this is some powerful stuff. Okay, well, next we're going to talk about the backdoor Roth for high income earners. We're going to talk about the Roth 401k. What's that 5-year clock? We got a lot more to go through next after the break. Okay, so we're talking about the Roth IRA, and so we're now going to be moving into real quick, I want to talk about the Roth 401k because there's some confusion people have when it comes to this. Let's talk about, we love the Roth. I mean, if people haven't noticed, we're big fans of it, right? But let's talk about the Roth 401k. So let's use this example. Let's say we got a client, and her name is Catherine. And Catherine's been contributing to her Roth 401k for a number of years. But keep in mind, she's never owned a Roth IRA. Then Catherine retires and she says, you know what? She meets with us and says, hey, I want to open up a Roth IRA, and she wants to do a rollover, which makes sense, right? You want to keep apples and apples and oranges in oranges. But Tommy, walk our viewers through this. How does the 5-year rule work in this example where she had a Roth 401k and she's never owned a Roth IRA?
In that instance, if the Roth IRA is being opened to receive rollover funds from a Roth 401k, it starts the 5-year window on the Roth IRA.
Okay, but wait a minute though. She's had a Roth 401k for years.
Yeah, so the rollover is a qualified distribution from the Roth 401k.
Yep.
So that full amount becomes the new basis for the Roth IRA, and any subsequent earnings from that point forward fall under the account level 5-year rule.
So folks, this is why we're telling you. Remember when we said start a birthday? Start a birthday, right? People. I bet you there's people listening right now, and they said, "I did not know that." I bet you anything there's somebody listening that said, "I did not know that." This is why you work with people that know what they're doing. I think that's the big thing, and why we do this show, to help people and guide them through this process.
If we have confused you through the first part of this episode,
which we probably did,
there's a lot of there are a lot of technicalities to be aware of, accessing the earnings, conversions, rollovers from a Roth 401k, all those pieces come together. But there's a lot of technicalities involved with a Roth. It's not put money in, it grows and comes out tax-free,
right?
Without following a number of rules in place.
Well, and I think that's also a good plug. I think people should also go to our YouTube channel. We got a lot of great information out there where we have full episodes. We do specific topic type of episodes to give them the content that they're looking for when it comes to their overall a financial journey, if you would.
They may be sitting here saying, okay, I understand how the Roth IRAs work. How do I get money in there?
Right.
Look at a tax planning episode.
Right.
You kind of walk through some different examples of how we would evaluate that process.
Absolutely. So we encourage everybody to do that. Okay. Wait, there's more. We got another one to go through here. And so let's talk about high income earners. Okay. Where they're over those thresholds in terms of what they can contribute to a Roth IRA. Tommy, walk our viewers through this strategy.
Right. So to make contributions to a Roth IRA, you have to be income eligible. On your screen, you can see those income levels, either single or married filing jointly. But for those who earn more income than the IRS defined levels, they cannot outright make a Roth contribution. And so when we're looking at this, they have an option through a backdoor Roth.
A backdoor Roth strategy. Yep, this is a pretty cool one. And so let's just briefly talk about this, and I'll have you give them an example. It's a cool strategy. And so this is where, again, folks, this is where you're making a non-deductible contribution to a traditional IRA. And let's just pretend you don't have any other IRAs out there, okay? You open up an IRA and you make a non-deductible contribution. Then you backdoor it, meaning that then you do a Roth conversion right away. We're good to go. We're good to go. But Tommy, what if somebody had, or let's back up. Let's just say somebody did a non-deductible contribution to an existing IRA that they've had for a number of years.
Yeah, you have to be aware of, the account aggregation, or what they would look at as the pro-rata rule.
The pro-rata rule.
Pro-rata rule. So
that's next. Let's talk about that.
Most people are looking and assuming making a contribution to your traditional IRA is tax deductible. At income levels, that is a non-deductible contribution. You immediately convert it. You say, oh, I didn't get a tax deduction on that. I converted it to a Roth. I'm not going to pay any tax on that process. What the pro-rata rule does is it goes back and looks at the amount you have contributed and converted, as well as the existing IRA balances, and then determines what portion of the amount you converted is non-taxable and what portion is taxable. I feel like I said a lot there.
There's a lot there, but our viewers you all need to hear this stuff, because again, like we said at the beginning of the episode, people just say, yeah, I got a Roth and it's tax-free. No, maybe not, right? So let's stay on this pro-rata rule, Tommy. No, everything you're saying is wonderful information. Now let's break it down for them. Walk our viewers through an example.
Yeah, let's make the numbers easy. So you make a $7,000 non-deductible IRA contribution. You forget about that $93,000 you already have in a traditional IRA.
That's right.
The IRS is going to look at that and say, combined, that's $100,000. So the non-deductible portion of that is 7%. The other is the 93%. So when you convert that non-deductible amount, you will have 93% of that converted amount as taxable.
It will be taxable. And that hence is called the pro-rata rule. That's big. That's a big one. And here's the thing too, folks, what counts is simple IRAs count when it comes to the aggregation rule in terms of all the, in terms of what counts as a traditional IRA. Inherited IRAs though, Tommy, let's talk about that one. Does that trigger the pro-rata aggregation rule?
Inherited IRAs do not get added into the IRA balances.
That's right.
It's its own class as an inherited IRA.
It's its own class. Okay. So Now, how do you fix this, right? And so here you got that $93,000 that you rolled over years ago from a former employer. You made a $7,000 non-deductible contribution into it. How do we get out of this, if you would? I mean, how can we fix this? What can this person do?
We're going to make an assumption that if you are a high income earner, you have wages coming in.
Yep.
So if you are still employed and your current employer's 401k, 403b, TSP, whatever it is, will accept rollover contributions from that IRA, you can take that traditional IRA, move it into your current employer's plan, and get rid of the IRAs, basically.
And voila, that helped. That could have fixed it if that employer allows that. Right. So if you have a solo 401k, that's where you could take it. We're out of time. I mean, there's nothing. This is a great episode, Tommy. I mean, if I know it's probably clear as mud for some people, but you know what? It's good that people get this information.
Right. If you followed along and it triggers some questions, a lot of times we can answer those in a 15-minute call.
That's right. We do encourage all of you to take advantage of that call. We're here to help you, guide you, give you the help you need. But again, folks, thank you again for listening. I mean, and we also wanted to thank you for making this show possible. And also, please DVR our show so you never, ever, ever miss an episode of Retire Vivid, as we're here to help you with your tax planning, investment planning, retirement planning during your retirement journey. Again, thank you for watching. We'll catch you next time right here on Retire Vivid.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.